Welcome back. You're still watching Smart Money on CNBC-TV18. Still with us is Ajay Tyagi of UTI AMC, and the topic at hand is sustainable wealth creation in challenging times. Ajay, before the break, we were talking about ITC and how one should sort of look at growth companies, but then there should be a hard stop. Once you notice that the company is not performing, then perhaps it's time to let go. Such high quality and high growth businesses usually trade at very expensive multiples as well, right? How do you deal with the issue of valuations? Even if a stock is highly valued, but if the stock is doing well, if there are no red flags, if the pedigree is strong, no corporate governance issues, do you still stay with it or do you move on?
Sure. I think, Sonia, we'll have to divide this question into two parts. Everything when it comes to investing has to be seen in the context of the time frame that the investor has. And I would say that this question of valuation becomes very, very pertinent if the investor is only having a 1 or a 2 or a 3-year time horizon. But actually, this question of high valuation fades away if you have a time frame of 5 years, 7 years, and 10 years. Because what matters in the long run, 5, 7, and 10 years, is not really the starting valuation. Of course, the starting valuation would have consequences on the overall return that you make, and I'm not refuting that. But I think over a longer term horizon, what matters the most is the quality of the franchise and the ability of that franchise to continue growing at a very healthy rate and continue growing very, very profitably while it's enjoying those strong growth rates. But if your time horizon is very short, then I think valuation becomes a very, very important point to ponder over. The second part of your question is, do these high quality, high growth companies, if trading at a valuation of 40, 50 times, basically mean that they are too expensive, even from a longer term perspective? I would say that the price earnings multiple, which is the shorthand for valuations, quite frankly, if you ask me, because that's the most convenient metric we all use, itself is related to the return on equity of a business and the sustainable growth rate of a business. I don't want to get too technical on this show, but if you dissect price earnings multiple, what you would realize is that the two most important variables which are impacting the PE of any business are its return on equity and its growth. And it's a positive relationship with these two factors. If return on equity is high, price earnings multiple will be high. If growth rates are high, again, price earnings multiple would be high. And by the way, if both, which is ROE and growth, are high, then PE can be even higher. So, the shorthand tells you.
Sure, can we take an example here? Because I do have two charts that I want to pull up. One is Jubilant FoodWorks, right? The classic example of a great business, high growth, but very expensive valuation. So here we have the chart from March of 2013, and this is all the way to September of 2022. There is a 49% correction that we've seen from the top, perhaps at extremely high valuations. So you have to be sort of prepared, Ajay, with that kind of correction because of a valuation discomfort, right? So the question that I'm asking is, how do you know when is the right time to be buying the stock? I mean, if you had bought way back in March 2013, the correction wouldn't have really impacted your profitability. But if you had bought a little later in the cycle, then you would have been sitting with steep losses. What do you do then?
And this is where, Sonia, my reply to your question, the first part of my reply to your question is very important. Are you in this for a 5-7 year period? Are you in this for a 1 or 2 year period? Because if you are in this for a 5 or 7 year period, then whichever point you embark on, and you can continue taking Jubilant as an example, whether you embarked on Jubilant in 2013, 14, 15, 16, 17, if you were having the patience to hold on to it because your hypothesis that you had written about the business was still valid, you would have made money regardless. Don't forget that despite falling 50% in the last 9 months, the long-range CAGR, the 10-year CAGR for Jubilant still remains a very healthy 25%. There are very few businesses which can give you that kind of a return sustainably. So I think the important thing, and I'm coming back to this, is to keep testing your hypothesis. Does Jubilant really remain a great franchise? Does Jubilant have the ability to increase its number of stores from, let's say 1,100 to 2,000 over the next 5-7 years? Does Jubilant have the ability to actually have more streams of growth coming in by launching new categories, which, by the way, they have recently launched. So I think these are the more important questions rather than just fretting about, look, is it too expensive? Can I just, book some profits here and wait for a couple of years before it gets more cheap? I think a pure quality investor is always looking at the business outcomes rather than fretting about, can the stock price correct more than the market? Yeah.
So we have another chart, right, that I do want to pull up, which is the chart of Info Edge. And if you look at that, of course, Info Edge has had a one-way rally all the way from March 2013 to it's almost a one-way rally actually till 2021 or so. But then the correction, it halved. It was a 52% correction that we saw. What do you do with a company like this? I mean, does the same argument that you made for Jubilant, does it hold for Info Edge as well?
I would say absolutely. And I didn't point this out when you were pulling up the charts on Jubilant. Jubilant too has gone through a massive 30, 35%, even a 50% drawdown in the middle of last decade. So it's not unusual for growth stocks to witness a 30, 40, 50% drawdown. I would say it's par for the course. You can look at not only high growth companies, high quality companies here in India, but even globally, the Googles of the world, the Facebooks of the world, all of these Microsofts of the world, all of these businesses do have sharp drawdown once in a while. Now, so for InfoEdge as well, what we are looking for is the ability of the business to hold on to leadership position in its core recruitment business, whether the business can actually, improve its leadership position in the real estate vertical. Can real estate vertical be a much bigger revenue driver for InfoEdge in the coming years and decades? And also the kind of patient long-term investments that InfoEdge has been very successful about when they invest into, certain internet-related themes at the infancy itself. So I think these are the drivers for InfoEdge, and this is what we keep testing for, rather than just looking at, are they overvalued? And if yes, should we just exit and then try and look for a more attractive price? We are more focused on channelizing our energies and attention to business outcomes rather than just valuations.
Okay,
that's typically how a quality
Sure.
manager would operate.
Sure. Okay, with such a strict focus on growth and quality, right? Are there enough opportunities available in the market now? Or do you feel that there is some constraint? Because it's very hard to find companies that are high growth and still are relatively okay on valuations.
Absolutely, I fully agree. But I would also want to take you back 100 years when the famous economist Pareto wrote the 80-20 law. And I think that law is applicable for every walk of life. And I think it's applicable for investing as well. History shows us, whether it's the Indian markets or developed markets, that barely 10 to 15% companies are able to really create all of the wealth. And I think when you look at the Indian markets over the last 20, 30 years, you would agree with me that there certainly have been less than 100 companies which have really created that sustainable wealth. So, I always consider this to be a very, very important starting point. It basically guides us that we don't need to fish in all the ponds. We really need to be doubling down and fishing into those ponds where the probability of finding out the long-term winners is very, very high. And this pond is what I've just explained. The economic characteristics of such businesses are high ROCs, ability to reinvest, long growth runways, very, very strong balance sheet with low to no debt, strong cash flow generation, and so on. If you can concentrate on this set of companies and be very, very focused in terms of picking out winners, your probability of actually, generating long-term wealth to our mind is high.
Okay, that was a very, very helpful explanation, and it's something that perhaps people are aware of, but they need a reminder time and time again, right? The wisdom or the pearls of wisdom with regards to wealth creation. Ajay, thanks a lot for joining in. Have a great day. Well, that's a wrap, but before we wrap up, we have a financial tip of the week for you. And today's financial health tip is, what is an income fund and what are the benefits of investing in income funds? Now, the objective of an income fund is to provide regular and steady income to investors, An income fund basically invests in fixed income securities, whether it's corporate bonds, whether it's debentures or even government securities. Now, the fund's return is from the interest income that's earned on these investments, as well as the capital gain from any change in the valuation of the securities. The fund will distribute the income provided to the portfolio, generates that kind of required returns. Now, there is no guarantee on the income, and the returns will depend upon the tenor and the credit quality of the securities held. But the biggest advantage of an income fund is high liquidity. Unlike some fixed deposits, income funds do not have any lock-in period, and they allow investors to withdraw their investment anytime. However, exit loads may be imposed for redemption in these funds from a 1 to 3 year period. Well, that's your financial health tip of the week. Keep it with CNBC TV 18. Thanks a lot for watching Smart Money.